Contagion in equity markets refer to the notion that markets move more closely together during period of crisis. Systemic risk was a major contributor to financial crisis of 2007-2009. Systemic risk has been a key ingredient in theory of risk management, asset pricing, and portfolio diversification. Recently, international diversification was considered a suitable choice because the weak correlation of return on international stock markets allowed for the diversification of risk. But in the aftermath of the global financial crisis 2007-2009, the debate concerning systemic risk and its measurement was also reviewed by several financial analysts and economists. Accordingly, traditional financial risk measure has been criticized, and systemic risk measurement has again become a topic of intense discussion among economists, bankers, analysts, and policymakers. All of them universally agree of the urgency to develop successful risk management strategy and more accurate risk assessment. Many empirical studies conclude that there is no clear evidence of a causal relationship between international stock markets. Furthermore, the relation is not the same when we consider the short and long term between international stock markets. It is important to consider the speed of information transmission. Investigation of intraday price linkage is crucial to improve our understanding of stock transmission and systemic risk diffusion from one market to another. Recently published two papers on this framework. The first one, modeling international stock price co-movement with high frequency data published in Macroeconomic Dynamics, and the second one on oil US exchange rate volatility relationship and intraday analysis published in Economic Modeling. And the first paper, our study investigates intradaily price linkage between the US market and the three major European stock markets, Frankfurt, London, and Paris. Two sub-periods are analyzed. The crisis period from July 2007 to March 2009, and the benchmark period from January 2014 to September 2015. We split the trading day into two periods, overlapping and no overlapping trading hours. We use a non-Gaussian multivariate generalized autoregressive conditional elasticity methodology to analyze the conditional correlation between these markets. To measure the contribution of the systemic risk for each market, we use the marginal expected shortfall approach. For the second paper, we examine the interaction between the oil market and the US dollar-euro exchange for the period from August 2014 to January 2016. Our research question is firstly motivated by significant recent oil price fluctuation. Indeed, at the beginning of 2016, the price per barrel of West Texas Intermediate crude oil reached $30 compared to the $140 in June 2008. Our contribution is twofold. First, we use high frequency data to develop more precise measure of continuous and discontinuous volatility implied by jump and the price dynamics. Second, in addition to the investigation of volatility spillover, we consider the intraday jump component of volatility. Accordingly, we decompose the realized volatility and detect intraday jump in both the foreign exchange market and the oil market. For the first paper, our investigation points to several interesting findings. First, we show significant time varying and asymmetric stock return linkage, indicating that markets and linkage and their reaction to negative shocks differ from their reaction to positive shocks. The marginal expected shortfall approach indicates that both European and US indices make considerable contribution to each other's systemic risk, especially following the collapse of Lehman and Brothers. We show that propagation of systemic risk is higher during the crisis period and overlapping trading hour than during no overlapping trading hours. For the second paper, we specify the driver of oil price volatility throughout a focus on extreme US exchange rate movements. We prove that there is a negative relationship between the dollar-euro and oil return, indicating that US dollar appreciation decreases price. The intraday analysis suggests that information arriving in the exchange rate market can also be interesting for investor in the oil market and drive its price.